you. Thank you, CES. Thank you, everybody watching on video. Um, if you've been with us this morning, we've been on a little bit of a journey. We looked at the role of banking in the age of AI. We looked at the role of banking and fintechs in an age of diversity and inclusion. Now, throwing that all out, we're going to look at why the hell do we need a bank in the first place? And this panel is called Alternatives to Traditional Banking. Now, if I told you 10 years ago, 5 years ago, I was going to the bank, we'd all have a common language, you'd know what I meant. That is no longer so true. The intermediaries that we have thought of as banks are shape-shifting right before our eyes. Are buy now, pay later banks? Is Amazon a bank? Is Apple Pay a bank? Is your bank embedded in some app that you use? Does the current banking world need to start thinking about the decentralization of the banking system? And you know that they are. So we're going to talk about all of those things in the next 40 minutes. And I am leaving you in the most capable hands. I'm going to introduce your moderator, Vartika Ambwani. Vartika comes out of early fintech companies, and she's currently the director at Silicon Valley Bank, fintech's growth team. And Vartika is responsible for the business and development and there, but you will see with this panel, whether it's Vartika at Silicon Valley Bank or the other panelists, that the notion of what is a bank is transforming before your eyes. So with no further ado, I'm going to invite the panelists to join us on stage. Enjoy.
Testing. You guys hear us? Do you guys want to quickly test your mic just to make sure it's working?
Testing.
You're good?
Testing,
I'm really loud.
Oh my. All right, we'll get.
testing,
Testing.
You're good.
testing,
Sorry, everyone. We're having some technical challenges.
testing.
Looks like I'm the only one they can hear.
Melanie is the only one who's going to
I
speak.
have a lot to say, so let's go.
Just in the interest of time, let's just get started. I'll pass the mic around if that's okay. Awesome. All right. Well, good morning, everyone. Thank you so much for joining us. We really appreciate it. As Robin mentioned, I'm Vartika Ambwani. I'm a director of FinTech at Silicon Valley Bank. Silicon Valley Bank, we're a very much commercial-only bank, very focused on the innovation economy. And we also position ourselves as alternatives to banking because we focus on our clients all the way from early stage, pre-seed, to public companies. And one of the things that we really pride ourselves on is actually our relationship approach. So not just providing banking commodity solutions, but really getting to know our clients and really focusing on what their needs are and providing them specialized products and services. So very excited to be here, and thank you again for joining us. I'm going to kick off by giving each of you the mic and just introduce yourself and tell us a little bit more.
Awesome. Thanks so much. Hi, everyone. My name is Don Muir. I am the CEO and founder of ARC. We are building the future of startup finance. We're a digitally native bank, purpose-built for high-growth technology businesses. In terms of my own personal background, I come from a late-stage private equity background in New York, where I experienced firsthand the pain points of traditional banking and traditional capital markets. When I moved from the East Coast to the West Coast to go to Stanford for business school, I met with dozens and eventually hundreds and now thousands of founders where I learned that these high-growth early-stage companies were being underserved by the traditional banks and capital markets. So we started ARC to fill that gap. And that was a couple of years ago. Now we're doing millions in revenue. We have hundreds of startup customers in Silicon Valley. And we're really excited to be building the future of startup finance and sharing that story with you here today. So thanks for having me.
Hi, everybody. I'm Melanie Hardin, and I work at Verizon's ecosystem and partnership group in the business division, not so much in the commercial, but in the business division. My background is I've spent the majority of my career in financial services, working for some pretty esteemed and well-known names. And I work a lot with private equity. So I'm a global partner network member of a very large, I think one of the largest, one of the earliest FTV networks. It's a financial technology partner firm. And I'm an investor in several other partnerships where we invest in either early stage or mid stage or late stage financial technology firms. So I have a huge interest in this. I have a passion for it. I really think bringing these sorts of tools to market helps the consumer, helps the business, and helps the economy in general. So very excited to be here. Thank you very much.
Mariana Danilovic. I'm the managing partner and founder of Infiom, which is a Web3 accelerator focusing on metaverse with Web3. So we accelerate companies that are a bit of a later stage. So they have raised a Series A round of funding and or had some revenue that's of significance in the last few years. And we also help larger companies, bridge the gap and enter into the metaverse with Web3 space. My background has been venture capital, innovation, acceleration for the last 2 decades. I started my career in financial services. I was an actuary, pricing some of the variable annuity products back then, did some sort of M&A work as well. At the beginning of my career, corporate finance after business school. And now I think it's all kind of merging together in these new sort of innovative sectors of FinTech and decentralized finance.
Awesome. All right. I got a mic, which is great. So Don, I'm going to kick it off with you first. So you talked a little bit about ARC. Tell us more about ARC, how ARC is serving its customers. And the theme of the session is alternatives to traditional banking. But I also want to jump into specialized financial services, which is what SVB does as well, and so does ARC. What is the importance of, or what is the value proposition in providing very specialized financial services?
Sure. Oh, great, the mic's working, there we go. Hi, everyone. So, like I said, ARC is building the future of startup finance. And what does that mean? Well, we're here today, as you point out, to discuss alternatives to traditional banking. But why do we require an alternative in the first place? Well, the reality is that most traditional banks, the counterparties that I worked with in my past life, working in finance in New York, are offline, relationship-driven financial institutions that lack technology. And that's fine in a lot of ways for later stage companies. But in the earlier stage segments, software businesses that are API driven and expect a consumer grade product experience across the full stack. At ARC, we view banking and finance as no exception. So we're reimagining the full finance stack for our customers from the ground up with the software founder in mind. We're giving the power back to the startup to run their own business, manage their own finances in one vertical SaaS platform. So that's the value prop of ARC. What it means in practice in terms of startup banking is that we're offering all of the bank essentials that you'd get with a traditional offline bank, but we're doing it in a digitally native, technology-driven manner. So instant money movement, instant access to funds, virtual cards, spend controls where the CFO can log into your web app and actually control who has access to capital, who can issue a new card. So for the first time, startups can log in to one integrated platform, tap into their future revenue streams, which is a bespoke financial product, to access non-dilutive growth capital upfront, deposit those funds instantly into a digitally native bank account that's FDIC insured and has all the bank essentials that you'd expect with your traditional offline bank, but without any of the friction that actually comes with working with a relationship-driven financial institution that doesn't necessarily invest in a technology offering. And that's the core value prop of ARC today.
That's awesome, Don. Thanks so much. That was very helpful. Melanie, I'm going to pass it on to you. So you bring a very interesting perspective. We're here at CES, and as we see, financial services are moving away from web to mobile. And one of the big infrastructure or one of the big things needed there is 5G, so we can build these products. So give us that perspective. Tell us how Verizon is committed to the innovation in financial services and how Verizon is helping the economy or helping the sector.
Yeah, thanks. So how we think about it is that carriers are the rails. So think about a railroad station or the loop or whatever. So we're the rails. So whatever, whether it be financial services, healthcare, digital, this, digital, that, as more people move their activities, their behaviors from the computer or any other access mode to their mobile, they're moving to the rails. They're moving to the carriers. And when you do that, you're moving to one of very few in the United States carriers, us being one. And so when we think about what people need in certain domains, and whether it be, as I said, healthcare, which is huge right now, digital health is becoming a big, very viable thing, and financial services, the three things people need that we offer through our 5G, and we are the largest in 5G, but through our 5G commitment, are security. So 5G offers an additional security level. And that's critical in financial services and in healthcare, as you could imagine, because of your records. And the second thing is bandwidth. So as experiences become more immersive, when you want to talk to your financial advisor, it's not just a phone call or some staid thing on screen, as you want to have it become more immersive, and I'll give you an example of that in a minute. And as you want it to be faster, low latency, you come onto a platform like a 5G and you get all that. So we're positioned at the embarkation of the future for anything like this. But one app that I was going to mention, and I don't even know the name, so I'm not plugging anybody here, and I'm not invested of them, disclaimer. But a lot of people that are young have trouble imagining their future in terms of savings. So when you introduce them to things like a 401k or 403b, whatever it is, depending on where they work, they save a lot less than they probably should. But there's an app that you can put on your phone, and it shows you aging. Thank God I didn't see this years ago. But yeah, you can look on there and you see yourself what you look like at 30 and 40 and 50 and 60 and by the time you retire at 70. So that gives you a whole different perspective on saving, because now you see yourself in the future. And so there's just an example of an immersive technology where you really would like to see that up close and right up and it's personalized to you. That really does help in terms of financial services and our anemic saving rates in this country.
That's very helpful to hear. One part where I'm really curious about, when we were prepping for this session, you mentioned how there are actually big financial players who are also moving from web to mobile. So not just startups, but really large traditional banks and even government agencies. Tell us a bit more about that, just in terms of how Verizon is working with them and supporting innovation, moving from very traditional industries to mobile and almost to FinTech.
Yeah. So. I mean, as I mentioned, healthcare and other industries are moving toward, because people don't want to boot. I mean, I brought my laptop with me, and I don't know, I used it once because I had to fill out some report that I was requested to do online, and it was a little more cumbersome to do it on my phone. But so phones are it, and you ask yourself a question, if you're in FinTech, would you rather lose your phone or would you rather lose your wallet? 90% will say, I would rather lose my wallet because I don't care. My phone's kind of caught everything on it. So, I mean, in a way, the perspective is that your phone has become your wallet. Your phone has become your central part of your financial profile. And you can do everything. You can send money. I mean, my daughter pays me rent. She does it by Apple Pay. And my other daughter uses Venmo, and one writes a check out, which is confounding. But, so the need for traditional financial services firms are becoming less and less important. It used to be in the old days, there was an adage that the more money you have, the closer you want to be to it. And so when I worked at one big, large financial service bank, they knew that if you had a safety deposit box with them, you would never leave them. It was just, those were the least people we were worried about attriting. We didn't care. We knew they'd be with us forever. But as you've got now with the technology, you don't care about that. What you care about is, I need somebody. I work in Silicon Valley. I work in a startup. I have equity based on my earnings, based on my equity ownership in this startup. I need a loan, and I just need somebody that knows how to do that.
Right.
And I don't care if he lives in Alaska or Norway or Finland or Miami. That's the guy I need, and so I need the technology to be able to do it. So there's a point for you.
And I think that ties very perfectly with our theme of having specialized financial services. So not just one size fits all strategy, but really specialized financial services where different stages and different sizes of companies have special solutions. Very interesting. Thank you. And Mariana, so we are going to talk about DeFi, exciting subject. So tell us a little bit more about what DeFi looks like in today's world, and how are major financial institutions preparing themselves?
So is it on? Mm-hmm. DeFi is decentralized finance. Is different. Does anyone know what DeFi is? Raise hands if you know what it is. Excellent. Okay. 5%. Someone said yesterday knows what DeFi is. So all the finance we know today, FinTech and traditional organizations, they're all centralized finance, which means all of our data is basically in a centralized server. And I suffered from a couple of credit card breaches on my way to CES, where they issued me a new card, because there was a breach at the company that issues the credit cards, and of our data. And this is, I'm kind of used to it now. I get 2 or 3 a year. So the decentralized movement started sort of as the next generation of the internet, where those breaches would be more challenging to do, because instead of storing everything on a centralized servers, it's stored on a variety of servers in a decentralized way, not easily accessible. The additional technology that developed on top of these decentralized networks, which are blockchain networks, is something called smart contracts. And smart contracts are basically legal contracts on the networks that are executing financial transactions on your behalf. So they're trustless. If you look at the financial services today, there's about 7.4% of the GDP is spent on intermediary transactions and somebody putting a trust to that transaction so that it can be executed. So when you're withdrawing money from a bank or getting a loan, there is multiple trust companies involved in getting that executed. In a decentralized finance environment, these smart contracts are in a trustless environment, so it's executed automatically, through technology. And that's really the movement of decentralized finance. You can see how in early stages of the development, this can go wrong. It's supposed to, do a lot of things right for a lot of people, but, bank the unbanked and underbanked globally, et cetera. But there are issues with it in terms of regulation, adoption, protection, et cetera.
Awesome. Thank you for that. We're going to come back to you to talk a little bit more about DeFi. But Don, moving over to you. So you gave us a great overview of ARC. And as we know, CES, there are a lot of startups here in the audience. Tell us a little bit more about how ARC vets them. What is an ideal client for the company?
Sure. So just to make sure I'm addressing the audience here, do we have any startup founder, let's say tech founders or operators here in the audience? Okay, good, a good number. So, and how many of you have experienced opening a bank account? Yeah? Maybe on the consumer side? So, who do we work with? Well, because we're a software business, we can work with companies across the full life cycle at the same marginal cost. So what's really interesting for ARC and how we're differentiated from maybe some of the offline, more traditional banks, is that we work with companies from the seed, pre-seed, bootstrap stage, all the way through IPO, across the full company life cycle. And we do that through a digitally native platform. Now, the companies that we focus on are high growth, typically recurring revenue, high-margin software businesses. And that's our core ICP because we have an embedded financing solution where we're actually converting those future revenue streams into upfront capital. We're allowing those customers to deposit those funds into their digital bank account and spend that cash, help them manage that cash to preserve a runway and to optimize cash flow and minimize burn. So we have a target segment, which is this high-quality recurring revenue SaaS business, let's say Series A through Series C. But the reality is we work with the smallest companies and we work with the largest companies. The unifying attribute is that our decisioning is fundamentally driven and it's technology, it's driven by technology. So our approval process, our underwriting decisioning is based entirely on the fundamentals of the business. So traditional market participants will oftentimes care more about who's on your cap table than on the fundamentals of your business. Did Sequoia invest in you? Did A16Z invest in you? Is oftentimes more important than the gross margin profile, the revenue growth, your unit economics. With Arc, we use back-end API integrations to make automated, real-time underwrite and account activation decisions based purely on the fundamentals of your business. So we're really leveling the playing field for founders across the world. And that's really unique and opens up an enormous TAM for Arc and for FinTechs to move into this market opportunity.
It's very helpful and very intriguing. Thank you. Melanie, going to pass it over to you. So you mentioned initially in your introduction that you're involved with the PE firms and you're very close to the innovation that's happening in the FinTech space and just in financial services in general. Tell us what you're seeing in the space and where you feel like the innovation will come in.
Yeah. There's a lot happening in the space. And by the way, I love ARC. I see very few companies that span from startup to pre-IPO or IPO. Most of them most private equity firms really focus on this segment. I'm a seed, Series B, Series C, or pre-IPO. So I like the fact that you span. I think that's wonderful. But here's what I'm seeing. It's interesting. I'm seeing a lot of what they call, just catchphrase, embedded finance. And here's what that means. It just basically means non-financial services firms that are participating in some kind of financial event, whether that be payments, which is usually the case, or loans, and sometimes DDA or checking accounts. But for the most part, I'm seeing payments and loans being the two easier forays to go in. You don't need banking license. You need money transmissions licenses, which are a little different, somewhat easier. But I'll give you an example. So there's a company out of Tampa called Gale Health, like Nightingale, Gale Health. And at their core, they're a staffing agency for nurses. So nurses go on, and as we all know, there's a massive nursing shortage in this country. So nurses will go on, and they'll want to pick up a shift here, pick up a shift there. Maybe you see it before Christmas because they want to get a little bit of money for Christmas presents. So they go on to Gale's website or on their app, and they see that there's a shift available tomorrow from 2 to 10 at this particular hospital or this clinic. They take it, and they go. So why is that FinTech? How does that relate to financial services? Because within 1 hour of that nurse walking out of that hospital or clinic, she's getting paid. So that's an example of embedded finance, and that's what makes that particular company so attractive. And I worked at the largest payroll company in the United States, and so there's lots of people kind of gunning for, like gig pay, I know was here before. There's lots of companies that are gunning for that market because there's so many people moving into the gig economy, even nurses that are looking for a shift here, a shift there, and paying them is critical. More than it is like with the W-2, you kind of assume you're going to get paid on Friday or whatever it is. So that's an example, I think, that's really, I like it because it's so far removed from finance, but it's so germane to payments that the marriage of those two industries, I think, is a really great example of what I'm seeing in the industry.
Yeah, that's a great example. And I think that's what makes FinTech and financial services so special in general, because regardless of the industry, you pretty much touch everyone. So that's great. All right, Mariana, moving over to you. We're going to talk about something very interesting, regulations. So financial services is very heavily regulated. What are you seeing on the regulatory front? And then tell us a little bit more about how can DeFi overcome what we're seeing in the industry at the moment?
Well, let's unbundle that because it's a couple different questions in there. Okay, what we're seeing with FTX has nothing to do with DeFi because it's really, that's a centralized company, both of them, Alameda Research and FTX were centralized operations. You know, unlike a Uniswap or one of those decentralized exchanges, FTX had a management team that was managing the exchange. Now, the liquidity issue, I think, is a much bigger issue for the whole market, and that's because it's not just an unregulated market, but it's a new market that's growing, and no one's really solved the liquidity issue, you know, company by company, and then as a coordinate system. So that's a problem that's kind of then taken and plugged quite a few companies in the space. You know, that's what happened with FTX. But decentralized finance is like the opposite of that. It's about removing FTX from being FTX, right? That's the whole idea of it, is that you don't need these trust sources to manage or mismanage your money, basically, that you're self-sufficient. I think IDG had an amazing breakfast. I've been going to their breakfasts for decades, and yesterday was probably the best I've seen. They are talking about digital self-sufficiency as kind of the major role of the consumers, and consumers want to be self-sufficient, and DeFi allows them to be self-sufficient without somebody taking over your crypto or your fiat or, you know, any other options that you're investing. So I believe that DeFi will develop because the digital self-sufficiency of the consumer markets and business markets, as you pointed out, would definitely lead us to that sort of decentralized methodologies. They will disrupt current methodologies because the trusted sources will be, you know, disrupted, just like the incumbents were disrupted with the Googles and Facebooks and Amazons of the world. That will happen over a period of time. The regulation is coming in a variety of jurisdictions, in a variety of ways, so it's even more complicated. So it's a complex, complicated system, but it's sort of the future of everything we do.
It's very helpful. All right, we are coming close to time, so we will be opening up for audience questions. But just one last question from my side for each one of you. So would love to just hear about, you know, your outlook on the industry in general and where you feel like the innovation will come next. So Don, we'll start from you.
Sure. Love the question. So the last 100+ years banking has been dominated by offline traditional financial institutions that aggregate hundreds of billions globally, tens of trillions of dollars of assets, and have built very deep, entrenched relationships with corporations of all sizes. Financial services, as you point out, is a highly regulated industry. That regulatory capture has created barriers to entry historically, which has made financial services and banking specifically one of the last frontiers in tech to truly undergo technological disruption. That's changing. Through the proliferation of banking as a service and other FinTech point solutions, we're seeing a lion share of market, particularly an early stage of bank deposits, the early stage shift away from traditional offline banks to FinTech point solutions and market participants. That trend started just a handful of years ago and has been growing exponentially over the last 5 years. When I look 10 years out and I think about the needs of an evolving modern day technology company, which will be every company in 10 years, it's digitally native, it's technology driven, it's leveraging AI for automated decisioning, it's leveraging automated KYC and KYB processes to approve new accounts in 10 minutes rather than 10 weeks, the relationship-driven processes. So looking 3, 5, 10 years down the road, the biggest change we're going to see in banking and in financial services, quite frankly, is that it will be dominated by by technology companies. Publicly traded technology companies will take the place of the large, current incumbents that have tens of billions or hundreds of billions of market capitalization publicly traded on the New York Stock Exchange. Those tickers will be traded for tech-first, digitally native businesses who are continuing to win share in the tech ecosystem today.
Awesome. Exciting future ahead for sure. Melanie, how about you?
I agree with that. There's one thing I would add, though, and there's an element of trust. And I saw Craig, who's from Craigslist, years and years ago speak, and he said, trust, it's the new black. And I thought that was kind of cool, so I thought I'd quote him. And it is, because everything will be digitally native. You can do this and do that and receive money and send money and get a loan and give a loan, all this stuff, but do you trust that platform? Do you trust the people who have started the platform? Do you trust the oversight? We've seen some lack of oversight with some of these financial FinTech companies starting out. And do you trust their processes? And there's two elements to trust. There's the intent. Are they well-intended trust, and you can trust them for that? And are they competent? You don't trust a 3-year-old with a pair of scissors, right? Not because he's ill-intended, but because he's incompetent. At least my 3-year-old was, so I'll just let somebody else speak for their own. But so that's what I think when you talk about the proliferation and the obsequiousness of financial services, and as I talked about embedded finance, I think it will take over quite a bit of traditional banking with an element, though, underlying it of trust. That's my thing.
Melanie, if I could just ask you a follow-up question there. Just in terms of infrastructure and 5G, where do you feel like that technology is going, and what role it will play in innovating the sector even more?
Well, 5G is trust. I mean, right, because 5G has added security that other levels don't. So we've, by nature of launching 5G, not only added really big bandwidth, like massive bandwidth, and low latency, so you can do things very quickly, and you can see a lot very quickly, but there's an added layer of trust. So cybersecurity is where I would see a lot. I was at the cybersecurity session yesterday, and now I'm scared to even use anything after listening to those guys. But I think there's... Yeah, I was like, wait, what? So I would say cybersecurity is a big place to watch, and that would be in conjunction with trust, in conjunction with the proliferation.
That's great. And
cybersecurity in Web 2 is a misnomer. No, I'm just kidding. So, no, I mean, one can get attacks in every environment, but yeah, that's something that we all have to solve. We haven't talked about the metaverse. Metaverse, as McKinsey's report talks about it, should be over $5 trillion by 2030, which is just a few years from now. It's not that far ahead. And about half of that is going to be contributed to e-commerce, and FinTech is going to play a huge role in that, and have a big share of that market. McKinsey does distinguish between the Web 2 metaverse, kind of the Metas of the world, and Microsoft's, and $120 billion that was spent in just the first half of this year on metaverse projects by corporates, and Web 3. $40 billion that was spent last year by VCs funding the Web3 project. So there will be metaverse in the $5 trillion range. Some of it will be from Web2 applications. Some will be from Web3. And then we had this amazing evening last night with Robin's other speakers, who are all just the brightest people here that I've met. And they were all saying, well, isn't metaverse kind of like that virtual reality environment? And it's really, McKinsey report specifically, after interviewing 3,500 CEOs of Fortune 500s, et cetera, said, no, it's the next generation of the internet. So as you start thinking about FinTech and banking and everything that we discuss here today, which I agree with, this metaverse kind of tectonic shift that's happening, because McKinsey doesn't care about startups. They care about the incumbents, right? So they're seeing what you're seeing. The incumbents are coming into that $5 trillion space. That tectonic shift is going to be about immersive internet, this self-sufficient sort of digital native attitude towards it, and being, having access to things when you need it, as you need it. Finally, we have the tech to do it, and we're going to be seeing that happening next year. I think all the metaverse exhibits here are going to look very different. They're not going to be VR.
That's great. Thank you, you three. I personally learned a lot, and this was very insightful. We are very close to time, but have some time for questions. So we'll open up for audience questions, and we have 2 mics that are running around. Any questions for our panelists here? I hear some chatter.
Morning.
Yes.
I have a question. As an investor, we hear a lot about FinTech and new companies, etc., and how they will change the world and how they will, be a problem for the incumbents, in this case, the banks. But when you look at the world, that is not actually what you see, right? You see Amazon basically gives you everything you want. Apple gives you everything you want. Google gives you everything you want. Microsoft, which 20 years ago were companies that, again, they disrupted the world, but it doesn't seem that anything can disrupt them, right? In terms of the banks, I would say, for example, in terms of ARC, you seem to be very specific in what you guys are looking for. You said it, high growth, high margin, quality companies. And this is not general world, right, of banking. And what prevents a big financial institution from actually doing even more like Amazon or Apple or Google does? How do you guys see that going forward? From my standpoint, what I see is that unless we have more antitrust, for example, what it seems is that these big companies are just going to take over everything. I don't know what views you guys have on that. Thanks.
Yeah, thank you.
I can take as well. So in the last 10 years, over 50% of the Fortune 500 companies are no longer on that list. And Google didn't really become Google until about 2004. So that's only 18 years ago. And Microsoft was around, but Amazon certainly had 2 toxic converts of 120 million each. They were about to put them out of business back then in that downturn period. So we're going through this similar sort of downturn for some of the new tech, and I feel like we're going to come out very quickly into that hyper-growth mode. And the incumbents can't compete with that hyper-growth mode because of the consumer basically wanting more than they can deliver. They can't jeopardize their existing businesses, and they can't do it fast enough to compete.
Yeah, I have a point on that, and I would call out your bank, which seems to have figured it out. And that's because I think of your location. Your headquarters is right there. So they had to early on, and they jumped on that bandwagon. But again, I come back to the trust point that I made earlier. Would you take all your money out of Fidelity right now or out of Charles Schwab and put it with a startup who's been vetted and is great, but doesn't have that kind of reputation or FDIC backing, for example? And so a lot of people right this minute wouldn't, but they will. So I do see, a very threatened environment coming up, and I think there's 2 reasons why incumbents won't adapt and can't adapt, and it is what we said here, but also that there's a lot of politics and there's turf inside of organizations, and so, particularly inside of something so conservative like a bank, that people want to protect. It's not simple. It's my job. I run this division. I run this group. I don't want to give it up. So very few companies are willing to cannibalize their own base. Very few. There are some, and I would call out your company. I would also call it Charles Schwab. They also used to be headquartered in the Bay Area. But very few companies will close this down. When Schwab, for example, launched the Intelligent Investor portfolio program, which was squarely aimed at Betterment and some of the robo-advisors, they had a 65% or 60% of their assets converted. It was all conversion from existing assets into these intelligent portfolios. Their margins went from whatever, I'm making this up, I'll just say, I won't make up numbers, half. They basically cannibalized half their margins and they didn't care because they would rather still have some of their margins than none of their margins. So there's an example of what they did and why they did that. The other thing, the second reason I think banks and financial institutions are struggling to compete is because of legacy systems. I mean, I worked for a large payroll company that was using like C++ at some point. I mean, they had like COBOL people. They couldn't retire and we couldn't get rid of them because they had to keep this system up. And they don't want to jeopardize payroll. God forbid you miss your payroll because you were putting in a new thing or you were integrating a new startup that you just bought. There's your reputation. So that's what I see happening. That was a great question. Thank you very much for that.
It is a great question. I completely agree with both answers. There's a lot to unpack and address specifically around where we are today versus where we'll be 10 years from now, and why banks haven't changed, why they haven't adapted to the rate of technological innovation that we've seen and enjoyed across effectively every other sector in the economy. The names you mentioned specifically, Google, Amazon, Apple, these are FinTech companies. These are now FinTech companies. They use embedded financing. They have embedded banking services. Apple could be the largest consumer bank in the world 5 years from now, right? So comparing these tech companies that have been driving the pace of technological innovation in the United States and globally to the large offline incumbent banks that have been adverse to change, adverse to adopting technology, I think is a really tough comparison to make in my mind. Now, why haven't banks adopted? Well, as I pointed out before, there's the regulatory environment. When you have enormous barriers to entry in an industry, it makes it harder to compete. It makes it harder for small companies to come in and take away share, and that makes you less inclined. I was going to say, use a different adjective. It makes you less inclined to adapt and change. You don't want to cannibalize existing revenue streams.
That's right.
At a bank, you have a P&L structure. You have a managing director who gets paid based on transaction volumes, based on relationships with their clients. They have a book. They have their own P&L. To come in and distribute that product using technology would be turning the entire system, the entire P&L structure for these legacy banks upside down. And that's really hard to do. So that creates a lot of opportunity for tech startups and now large tech companies to come in and take share away from traditional banks. The banking as a service, the proliferation of BaaS, right? So banking as a service, which opened the door for fintechs to come in and compete more directly with banks in partnership with other banks, has created a huge problem for the incumbents. And if you read Jamie Dimon's annual letter to his shareholders, you'll see that fintechs are the #1 threat to JP Morgan Chase today. Jamie knows this. They're trying to adapt, they're trying to innovate, and I think they've actually done a pretty good job relative to some of the other banks in the market. But the reality is, fintechs who have focus, who see this market opportunity, who see that the traditional banks are not adapting fast enough to keep pace with the evolving needs of their tech clients, they're going to continue to pick up share in an accelerating manner. And while regulators might try to prevent this in the short term, over the long term, the consumer is always going to win because customers want a technology-driven, digitally native experience. They want a more frictionless experience. They want a faster, better, more fair, more equitable experience. And that is what's going to drive the change over the long term. That's why technology is going to win. And that's why 10 years from now, FinTech will dominate banking. That's my view.
That is great. We're right at time. I think the only 2 words I would say just to close this out, regulations and trust. And the reason why we have the market share that we do is really primarily based on trust and your reputation in the market, which, especially when it comes to money and it comes to financial services, is so key. All right, you guys, thank you so much. This was an amazing session. Thank you, everyone, for being such a great audience, and enjoy the conference.
Thank you.